Welcome to the second episode of the Investment Hound podcast series. On this podcast, we'll be discussing how to be a successful investor and how you, a beginner investor, can achieve realistic investment goals in stock markets around the world. My name is Adam Boogie, the novice investor, the student, the host, and also the grandson. And in this podcast series, I'm going to be joined by a veteran investor, someone with vast experience in economics, finance, and investing, a former director of corporate banking for Bank of Ireland, who also happens to be my granddad, Mr. Paddy Strong. On this episode, Grandad and I discuss the core principles of investing, how to judge markets, and what you should look out for in a stock. If you're not a podcast listener or you prefer to read, or even if you're looking for a good, useful present for someone, be sure to go and grab yourself a copy of Grandad's new book, Successful Investing: How to Make Money in the Stock Market from Real Life Experience. In his book, Grandad simplifies down his investing strategies throughout the years, making it easy to consume for you, a beginner investor. Don't get me wrong, the stock market can be a very intimidating place, lots of new numbers, terminologies, graphs, and so on, but in his book, Grandad simplifies it down so that it's easy to consume and understand for a beginner or novice investor. So go grab yourself a copy of his new book today, that's Successful Investing: How to Make Money in the Stock Market from Real Life Experience. Last thing, if investing is something you're interested in and you also happen to like this podcast series, be sure to go and follow us on all social medias at The Investment Hound. And one more thing before we get into the podcast that I want to say, just as I was editing the podcast, I noticed that my dog is snoring really heavily in the background, and it occurred to me that the listeners might think it's me breathing real heavily into the mic or something. So you can see her in the bottom right hand corner of the screen. Jessie is her name, so just please excuse that. I apologize. Now, enough of me rambling on. Let's get to the podcast. On the last episode, we reached a conclusion that the smart way to save via the stock market is to invest in large companies that are well established in their chosen markets and that also pay good dividends to their shareholders. The view expressed was that these companies will bounce back from market wobbles which regularly affect markets. In fact, the time to buy is when markets are experiencing low points, as many of these companies are trading at attractive bargain levels, or as Rothschild said, buy when there's blood in the streets, even if it's your own. So the first question I have for you today, Grandad, is how do we know when these markets are trading at low points, and how do we identify shares that are trading at bargain levels?
Well, to tell you the truth, Adam, I'm going to answer that question, but I'm going to preface it with 2 points, because you're now going to, people are now going to start going into the markets. And I think it's important that they have a couple of things in their head before they go in. The first is, the core principle is that you actually invest in the future, not in the past. So if a company has done very well in the past, that's no guarantee that it's going to do well in the future. So what you have to do is ask yourself the question, is this company going to do well in the future? And if it is, well, then obviously you might be attracted to the share. So an example I'm going to give you is the Royal Mail, which is the UK Post Office. And the Royal Mail were paying a dividend at one stage of 10.83%, which was an astoundingly high dividend. Now, the problem you have is when you see something that's astoundingly high, is it sustainable? Or is it in there on the basis that ultimately it'll flop back down? Well, I didn't believe that the Royal Mail could afford to pay 10.83% to its shareholders every year. So I avoided the stock. And the following year, the Royal Mail cut their dividend by 70%.
Oh my God.
So you have to ask yourself the question, when you see something that's attractive, but can it be too attractive? If it's too attractive, you have to be careful. You are investing in the future. Can they do things in the future that they've done in the past? The second core principle that I want to talk about is diversification. Don't put all your eggs in one basket. I'm going to give you a couple of examples. In the past, when I was building the portfolio, I invested in 13 different bank stocks. 5 of them lost money, and 8 of them made money. And overall, I had a return of 12.5%. If I had put my money into the 5 stocks that ultimately lost money, I would have been in deep trouble. So by spreading your risks, you're hoping that you get enough right to avoid the problems or to offset the problems, the ones you get wrong, because everybody gets ones wrong and everybody gets ones right. So you need to actually, I don't put all my money in one basket. I spread it around all over the place. And so those are my sort of 2 core principles that I would always take and put into place.
So would you say then that you kind of invest into sectors rather than into individual shares?
Well, I don't invest all in the one sector.
Okay.
I think I gave the example in the last podcast about the guys who actually diversified in bank shares in Ireland by investing and putting a third of their lump sum that they got from their pension into Bank of Ireland, a third into AIB, and a third into PTSB, which were the 3 largest bank, or sorry, not PTSB, Anglo-Irish Bank. They were the 3 largest bank stocks in Ireland. They all were wiped out. All those 3 banks were wiped out in the financial crisis, and the people lost all their money. Whereas when I invested in the 13 banks, I invested in UK banks, US banks, Irish banks, French banks, Spanish banks, Italian banks. The only one I didn't invest in German banks. They're not good to invest in. But what I basically, Dutch banks I invested in. So that gives you spreading of your risk. But I didn't put all my money into banks. I put some into banks. I put some into insurance. I put some into property. I put some into companies, construction companies, pharma companies. I put it across all the different sectors. And within those sectors, I spread it among a load of banks or a load of shares in those sectors.
Okay, so always invest into the future, not the past.
Yes.
Don't look back at what a stock has previously done. Look forward to what they are, or you predict they are going to do.
That's correct.
And
yes.
Spread your risk across different sectors rather than individual shares.
Yeah, and for example, I invested in automobile stocks. I bought 5 different automobile stocks in Germany, for example, in Japan. And at the end of the day, of the 5 stocks that I invested in, 3 of them I lost money on. But the 2 that I gained money on more than made up for the losses on the ones that I had invested, the other 3.
How will I actually know when these markets are trading at low levels to invest?
Well, there are things called market indices. And the market indices are a basket of the major stocks in a market. So the S&P 500 is the 500 largest companies quoted in the US. The DAX is the largest German companies, and the FTSE 100 is the 100 largest companies quoted in London. So if you keep an eye on the indices and you see that all the indices are down, say 5%, well, then you know that no market is trading up. But if one market's up 5% and the other 2 are down by 5%, well, then, the 2 of them are down and 1 of them is up. So it's very easy to track those indices. They're quoted in the stock market. You can invest in them as well. And what they say is that if a market generally, they can rise and fall by 10%. And that's, if you like, par for the course. That's not something that you should be frightened about, okay? Because that's happening all the time. They're going up close to 10% or down close to 10% over time. They call that a market correction. So that if the market falls by 10%, what the market participants are saying to us is that market actually shouldn't have been up there. It needs to be corrected back down. So that's just fine. Don't worry about that. You then have things called bulls and bears. Now, bears, I don't know whether you ever saw that book. Did you ever see the movie, The Jungle Book? Adam?
Yes.
Do you remember Baloo, the bear?
Yeah.
Do
Yeah.
you remember when he was fighting? He fought by retreating.
Okay.
In other words, he didn't fight the enemy by going to them. He fought the enemy by moving away from them and clocking them one or two or three as he moved away. Another famous bear was Muhammad Ali. If you ever saw any of his fights, he was always backpedaling as he, jabbed and hit the opponents. So that's bear. The bear, if you like, is coming away, moving away. And a bear market is a market that is actually, down by 20%. So effectively, that's telling you, okay, that people are rushing out of the market. That's a good time to buy, actually. A bull market, on the other hand, I don't know, have you ever seen any bullfights on the television or
Yeah. Yeah.
movies? You know the way the bull is always rushing towards the
Yeah.
matador. So the bulls rush in and the bears rush away. So the bull market is when the market goes up by 20%, people are rushing in. Okay. But when it's gone up by 20%, it's gone up by 20%. That's not a low point. But when it has fallen by 20%, that's a low point. Now,
Okay.
you wouldn't invest in a share that is you've fallen by 20% if the market hasn't fallen by 20%. You're looking to see if the market has fallen by 20%. If your share has fallen by 20% and the market hasn't fallen by 20%, let's say it's risen by 5%, you'd sell your share then because it's obviously got a specific reason for falling and not participating in the market rally. So the bulls and bear markets are determined by looking at what the indices are doing. The S&P, the FTSE, the DAX, and so on, what are they doing? And if you can find out what they're doing, and if it's going down by 20% or more, all the shares are going down by that, then you'll have bargains to be got.
So let's say you have identified that in a hypothetical scenario that the S&P experiences a correction of 10% downwards. Yeah.
Mm.
Is that something that you should look as an opportunity?
It's a small opportunity. If
Okay.
it came down by 20%, it'd be a much bigger opportunity.
A much bigger opportunity. Okay.
But I think if we go back to, we discussed Coca-Cola, if you remember the last time,
Yeah.
the last podcast. Well, the last time that markets collapsed by 20% was when COVID hit the markets. Now, that was, if you like, an impact on markets somewhat similar to the market collapse when the financial crisis arose. So it was a big crisis when the pandemic came. Now, if you had invested in Coca-Cola a week or two before the pandemic affected the markets, you'd have got a dividend of 2.8%. If you invested a week or two after the pandemic hit, you'd have got a dividend yield of 4.4%, because the price would have been down, but you'd have been getting the same dividend.
So, Grandad, let's say in a hypothetical scenario, one of the viewers watching at home had 10,000 in spare cash and they wanted to invest it. Would you recommend that they invest now, or that they wait for a bearish market, or can you find bargains during these bullish markets that we're experiencing? Because I know the S&P is at an all-time high, NASDAQ is at an all-time high, FTSE is down, I know that.
Yeah, the FTSE is down, but the question is, has the London market got a future? An awful lot of the shares that are being quoted in London are moving across to be quoted in New York, because the markets in New York are stronger than they are in London. So it may be that the FTSE is down, but it may be that it might be going to stay down. There's a fundamental, if you like, shift occurring in London, which would lead me to believe stay away from London for the moment.
Okay.
On the other hand, if you can find shares that are generating dividends of, say, 5%, and they're not paying out too much of the profits to actually pay shareholders that 5%. Well, those are bargains, you know,
Mm.
whether the market's going up or down or whatever. So if I could find, because I'm a dividend chaser, if I could find shares that are paying 5%, and I believe that they would continue to pay 5%, I don't get involved in whether I think the share price is going to go up or the share price is going to go down. I'm pocketing the dividends.
Okay. So what would you recommend then someone do at this stage? Do you think they still look for bargains, or do you think they wait for bear markets?
Oh, no, I'd say they should look for bargains.
Okay.
All it means is that if there is a bear market, there's likely to be a lot easier to find the bargains than if
Okay.
there isn't a bear market.
Okay, very good. So then, just to kind of summarize what you said there, if markets move up by 10% or down by 10%, it's called a correction. And if it moves down by 20%, it's a bear market. And up by 20% is a bull market. And I should only really be worried if the share price is moving in the opposite direction to a bear market.
Yeah, no, not quite. If the share price is falling, but market index is not falling, then
Yeah,
the share price is falling when the market is, say, rising.
yeah,
Well, at that point, you know there's something wrong with your company. It should
yeah.
be doing what the market's doing. So I would always worry about that.
I'm starting to take notes of these, Grandad, so I can apply them to my own investments.
But when you make your first million, don't forget who showed you how to do it.
Oh, of course not, of course not. You'll be getting a percentage of the dividends. So, should we believe that these noticeable market declines or these bear markets will be followed by recoveries? Like, is it always the case that these bear markets are followed by bull markets?
Yes, I believe it is so.
Okay.
And history shows that it is so. I think I said to you before, the S&P rose 300-fold between, I think it was 1880 or something like that, and 2020. And it went through 2 world wars. It went through 2 pandemics at that time. And, it all sorts of shocks and so on and so forth. Yet there was an inevitable rise back from all the wobbles and a continuing rise. Because what happens, why does that happen? Under normal circumstances, if a business only gives out 50% of its profits to the shareholders, it holds on to 50% of its profits every year, and therefore it has more money to invest every year. So if they have a good business model and they're, prominent in their market and well regarded, the chances are they'll be opening new shops, or they'll be, diversifying
Expanding. Yeah.
into different countries and so on and so forth. And the chances are the earnings will rise, and therefore the share prices will rise. That's under normal circumstances. But if you have say a 20% correction in the market, as we had, for example, with the pandemic, what actually happened? Never underestimate the ingenuity of mankind. The first thing that businesses will do is they will cut back on their activities to try and protect their cash. The second thing is that the central banks will lower interest rates. So the Bank of England will lower interest rates. The ECB, which is the European Central Bank, will lower interest rates, as indeed they did, and during the pandemic, for example. And the S&P, the US Fed, will also lower it. And by lowering interest rates, that reduces the cost to business of borrowing. It can also, if you have a variable rate mortgage, actually reduce the cost for customers paying back their mortgage. And that all enables businesses and customers to spend more money. But on top of that, because interest rates are low, governments can afford to borrow more money. And so they'll borrow more money, and then they'll give out handouts to businesses and handouts to households to help them to, first of all, deal with the tighter market conditions, and secondly, to spend more. And as businesses and households spend more, then markets will recover, and then share prices will come back. And that's what has happened time and time again. So I'm of the view that provided you can hold on to the shares and you don't have to sell them when they're down at a low, in other words, if your time horizon is long enough, then you can actually get through all those wobbles and continue to show increases in your savings.
Okay. So the governments will always try to re-stimulate economic activity during these downturns.
Yes, they
And
will,
assuming,
because I'll tell you why that is, Adam, right? Because if they don't, at the next general election, they'll be booted out of office.
yeah,
Because the only power that a voter has is the power to kick the government out of office. And if the voters are all feeling annihilated by tight market conditions, they'll blame the governments and they'll vote them out of office. So governments have a vested interest in bringing things back together again to recovery.
so during these economic downturns, Grandad, or during these times when there could be bargains, what do you actually look for in a stock to identify if it's a bargain or not?
The first thing I would look at would be the dividend yield. Can I get a good dividend yield, right?
Okay.
And if I can get a dividend yield of 5% or 5.5%, my current portfolio is yielding me 6.5%. Okay. So, if I see a share that's giving me 4.5, 5, 5.5, 6, I get very attracted to it. All right. But then because of that, I'm then worried. Can they afford to pay that dividend, or are they like the Royal Mail, or are they going to cut it next year by 70%? So I look at a thing called the payout ratio, which you can get on Google for any company. It'll tell you what percentage of the profits are actually distributed by way of dividends. And if it's 50% or less, well, then I know there's enough cover there so that if they get into some difficulty next year, the chances are they'll be able to continue to pay that dividend. The second thing is the analysts. These are the guys who actually follow shares and, crawl all over the balance sheets and profit and loss accounts and visit the companies and talk to the management and so on and so forth. What are they saying about the share? So, for example, in Coca-Cola's case, I had a look at it there recently, see whether the analysts were saying buy or sell or hold on to the share. There were 19 analysts following the Coca-Cola share, and they all said buy. Nobody said hold on to the share. Nobody said sell it. The whole 19 of them said buy it. Now, when I looked at Pepsi-Cola, which is a similar company to Coca-Cola, obviously, there was actually 23 analysts following the Pepsi-Cola share, of which 12, roughly 50%, said buy, 10 said hold on to it, and 1 said sell. So on that basis, Coca-Cola is getting a vote of confidence from the analysts, slightly higher than the vote of confidence that the analysts are awarding to Pepsi-Cola. The other thing then was, in terms of the PE ratios, which is the price earnings ratios, which is effectively, telling you whether, in fact, the share is, if you like, expensive or not. Let me go back and explain that to you, if I can, Adam, right?
Yep.
If you have an apartment, and I have an apartment, and my apartment is giving me $1,000 a month in rent. In other words, 12,000 a year. And I'm willing to sell it for 200,000. And you have an apartment, but the rent on your apartment is 2,000 a month. So instead of getting 12,000 like me, you're getting 24,000. And I'm willing to sell my apartment for 12,000. What would you want to get for your apartment for it to be attractive for you to sell?
Double what you're charging for yours.
Yeah, because your rent is double.
Yeah.
So the price is always a function of the earnings. Okay? And that's what they mean by the PE ratio. And the PE ratio for the S&P market averages 23, whereas for the DAX, it averages for only 14. And for the FTSE, it averages only 11. So Coca-Cola and Pepsi-Cola are both quoted in the S&P. Coca-Cola's PE ratio is 24.8, a smidgen above the 23. And Pepsi-Cola is 25.7, a smidgen above Coca-Cola. So Coca-Cola looks a teensy bit expensive, but not dramatically so against the average of 23. Whereas Pepsi-Cola looks a bit more expensive. So I would sort of prefer Coca-Cola to Pepsi. And the analysts seem to prefer Coca-Cola to Pepsi as well, as I've already said to you. And then I look at the dividend yields. And Coca-Cola's dividend yield is 3.2, whereas Pepsi's is almost the same, but slightly lower, 3. So on the face of it, you'd say to yourself, Coca-Cola seems to be a better buy than Pepsi. The question is, would I buy Coca-Cola today? The answer to that is 3.2% is not attractive. 3% is not attractive. When, in fact, I can get 6.5% on all the shares I have at the moment. So that's just too low for me to be interested in it.
Okay. So just to summarize what you said there, when you look for a share to buy, the first thing you look at is the payout ratio to see how much are the company paying out of their profits to the dividends to the shareholders.
Yes.
The second thing you look at is see what the analysts who are tracking the stock say about the stock.
Right.
And surely, Grandad, if there's, as you said, for Coca-Cola,
what they're saying about it in the future.
in the future. So surely if there's 19 analysts where their job is to track stocks, surely you should just go off what they say the whole time, no?
Well, they could be wrong.
Okay.
I mean, let me read this. I'm heavily influenced by what they say.
Yeah.
But I'm also heavily influenced by the dividend yield and by the PE ratio.
Yeah.
You know,
Would it also go back as well, maybe to
influenced by their strategy, and there's loads of other things I'm influenced in it.
Yeah.
But certainly the PE ratio and the dividend yield and what the analysts are saying about it in the future are important to me.
Okay. Yeah, and then I was going to say, and the third thing is that you have a look at what the P ratio is, and let me just make sure that I have a full understanding of what the P ratio is. Okay, so the P ratio is measuring the current market price of one share to how much earnings one share equivalates to for the company.
Yes, there can be a twist on it. They can give you last year's earnings against today's price.
Okay.
Or they can give you the analysts' consensus on this year's earnings against today's price. In other words, it can be a lagging indicator or a leading indicator. Do you follow me?
Yeah. Yeah.
I don't mind.
It would be fractional, anyways, wouldn't it? A fractional difference.
Oh no, it could be quite different.
Could be. Okay.
Like Royal Mail, paying over that amount of money in dividends, it's a big warning sign, Obviously, they had one good year and they paid the dividend. But in fact, that wasn't a sustainable earnings flow, if you know what I mean.
Yeah. Yeah. And then a good PE ratio depends on the market that you're trading in, does it?
Does, yeah, because like the American market generally operates on higher PE. Like they operate on 23, whereas the London market operates on 11 or 12 or whatever it is I said to you, right? So one is nearly double the other.
And why does that happen, Grandad?
Because the market participants believe that American companies are going to be more profitable in the future than British companies.
Okay.
And that's why companies like Irish companies and that are quoted in London and British companies that are quoted in London are starting to move across and be, in fact, quoted as their primary listing in New York.
Yeah.
So the Irish company CRH, which is a cement company, moved across. And when it did, its share price shot up. It was justified by the market participants because CRH had gradually over the years put more and more investment into the American market so that their activities were more American than Irish or British. Similarly, but a number of companies have done that, and a number of more companies are doing it. That's why I'm saying to you, the London market at the moment is kind of scary to me.
Yeah. And that's a knock-on effect from Brexit, is it?
Uh, no, it's because the American market is powering ahead, and by the way, the European market is also only trading at 14 times earnings, right? Europe was very, very dependent on China. In that, say, take Germany. Germany had huge exports to China. The Chinese economy is now slowing down, which means that the potential for the German market to grow has been cut because their main market that was causing the growth, namely China, has slowed down dramatically in the last year to 18 months. So the PE ratios in Europe, including London, are way lower than the PE ratios in New York. Now, that means that if you were just working on the PE ratios, you'd say that, well, the European shares are undervalued. But if they're undervalued for the good reason that China is slowing down, if you believe that, then you wouldn't be investing in European markets. On the other hand, if you invest in American markets and you're paying 24 times earnings for it, you have to keep your fingers crossed that the good times in America will continue. And of course, so every market has its difficulties. So but if you can get a good dividend out of the markets, don't worry about the price.